Hello, happy morning to all of you guys, wherever you are. It may not be a morning for you, but happy morning regardless. Okay, so I was taking a little bit of a look at our notable earnings here in our upcoming earnings module on the tool, in which you can kind of see a breakdown of what is happening with the earnings, the upcoming earnings for companies. And these are the notable ones. These are basically earnings that are coming from the Nasdaq and the S&P 500. You'll see that an interesting one is Pepsico right now, and it's also trending. I was taking a look at it again via the tool. You can kind of take a look here and see the social trends. When you compare it to yesterday, you will see that there is a massive increase in terms of activity in stock tweets, which is by far the most important thing when we're talking about sentiment and trends for a company, because it's being discussed every day. Pretty much, it's stock tweets is about discussions, like discussions and messages that people are leaving on a board. So you'll see that a massive increase in activity is happening right now, I guess because of the upcoming earnings, which likely I believe are going to be in about a few hours before the market opens, if I'm not mistaken. We can kind of verify that if we take a look at the company profile. It's July 12th, 12:30 basically. So yeah, the next thing that I kind of want to take a little bit of a close look is the price targets. And you will see that people are having a price target of 185, 168, 173. A price target that is not very variable. Here it's very similar to each other. This is a company, of course, that doesn't move too much, has a low beta, and it's currently sitting at 170, meaning that it also hasn't gone down a lot from its 1 year high. It hasn't really suffered from the current market slump, almost hasn't moved really. If you take a look at the 5 year chart, it's a company that has steady growth and is paying some steady dividend as well. This is a company that is a defensive company. You can kind of see it here as a consumer defensive. It is a company that is maybe beneficial to own and having your portfolio when you have a slump in the overall economy. Now we are waiting for its report here. You can take a look at the stock news module. It's talking about a harbinger for the Q2 earnings season. Many analysts are warning of an earnings recession that will start in the quarter just ended. If that's the case, then a company like PepsiCo will have a lot to say about the state of the American consumer. A lot of articles are talking about this, and it makes a ton of sense. They are about the consumer here, PepsiCo, and we need to see what they are coming back with in their earnings report. So this is one that may be very, very interesting to watch out for. Now we will take a look at the company's analytics here, at the company's numbers, to see whether it makes any sense to buy this one for our portfolio. If you take a look at the P ratio and the price to free cash flow here, you will see that they are a little bit elevated, 23.3, 33.7. Now, they used to be a little bit more, but overall they are at about the same level. 23 and 33 are, generally speaking, relatively high for a company of this sort. But again, we will examine that in more detail with our stock evaluation tool a little bit later. The outstanding shares have been going down just a little bit here, not tremendously, but still, so that's a good thing. The company seems to be having quite some total liabilities compared to the free cash flow that they're generating. We will examine that. This may actually mean that they have quite some debt over here. Now, they may be doing that on purpose, of course. And the revenue growth, net income growth have been increasing a little bit. The free cash flow has been staying about the same though, and the total equity growth at about 48%. Now, if you have extra debt, you can potentially have an extra return on equity, and this is rather high, 62.2%. But take a look at this debt to equity ratio. It's pretty high. Debt to equity is 2.25 here, so for each $2.25 of debt, we have $1 of equity. It's rather high, as you can understand. Net income margin of about 12.5%, and a dividend yield of 2.5 over here is the last 12-month one. But take a look at this payout ratio. In terms of its free cash flow, it's very high, 86%, and in terms of the net income, 59%. I want to take a little bit of a look at our dividends module here, see how that has been growing through the years. You can see it here, and the current dividend yield based on the current price of the stock today is 2.7%. But again, it may be a little bit unsafe here because it has a very, very high payout ratio. So yeah, I don't know for how long the company will be able to sustain this kind of dividend really. But they have been paying that for many, many years and have been increasing it for many, many years as well. Okay, so let's take a look at the financial statements. Overall, this has been a safe dividend for this kind of company, but it looks like in terms of a percentage, it's becoming a little bit too high. 63 billion to 79 billion is what they are doing in terms of revenue since 2017, and net income 4.8 to 7.6, increasing nicely here. Nothing explosive, but again, this is a huge company. It's a blue chip, a very, very well known one, and you can't expect amazing growth through the years. It's more than likely going to be steady growth, and that's fine. That's absolutely fine. Now, if you take a look at the total debt that the company has, it has been increasing a little bit in the past years, more than what was 2017 over here, I believe, 2019, sorry. And the total equity from 10.8 billion to 16.15. Well, in the meantime, they have also been buying back some shares, so that's another good thing to see. The company has been increasing their equity here. Then the other thing that I want to take a look at, of course, is the cash flow. And you will see that from 4.8 to 7.6 billion net income, we're getting 9.9 to 11.6 billion in net operating cash flow over here. And in terms of investing expenditures, it's for the most part capital expenditures, as you will see as well, and some sales of investments in the meantime, or purchases of investments. Nothing fancy happening here. For the most part, these capital expenditures really. And the dividends paid 5.8 billion over here. And if you take a look at the free cash flow, it was almost 7 billion. So you can understand that's about what, like 70, 75%, 80%, something of that sort, in terms of the percentage that the company paid for dividends. So they're basically distributing all their free cash flow back to shareholders. And take a look at the previous year, this was actually even worse. 6.3 billion is what they made, and 5.5 is what they paid back to shareholders. That's a hefty dividend. Back in 2019, all of its free cash flow went to dividends. So they're paying a very hefty amount of dividends to shareholders. Again, at some point, they may have to potentially reduce this dividend or find a way to increase their free cash flow. And that's a little bit too much. It's getting to a territory that's a little bit too high for me. This kind of dividend can eventually be unsafe. Again, if we go back in our stock analysis tool here, you will see that we are sitting at about 86% of our free cash flow. It's a little bit sketchy here. I don't want to say that personally. The stock evaluation tool, we will use what the company has been doing in the previous year to come up with what we could potentially and what we should potentially pay for this company. Now, the company has been growing at variable rates, but overall, I'd say they're probably at about 2, 3, and 4% is what makes sense here. They had an odd year over here back in 2021 where they grew 13%, but this is the odd one out, so I'm not going to go with this one. I'm going to go lower. The net income margins that the company has, again, a little bit variable, but overall about 10%, I'd say. And we will go 9, 10, and 11 over here. The free cash flow margin is going to be 75, 89, 90. So we're going to go 75, 85, and 95 for this one. And 13% for annual return is what we want to be achieving typically. Let's hit calculate. What are we getting here? Yeah, as I would expect, the company stock price is expensive for what we would want. And yeah, we did go with low revenue growth. We could potentially try a little bit higher, but 4%, which is still, I think, pretty fair. It's the 5-year average or close to that, 5% potentially maybe. We're sitting at $94 and the current price is 170. So if we go a little bit higher in terms of revenue growth, let's just go 5, 7, and 9. This is going to be much more aggressive in terms of expectations. We hit calculate here, and then you still see that we are far from our current price. So the company's stock price is expensive, and while this is a nice defensive company to potentially own, there are a couple of issues with it. First of all, it's expensive. Second of all, the free cash flow payout ratio is very high, and so the company may have issues with actually fulfilling their dividend payments. And this is scaring me, especially at this current environment. And a company of this sort, you will see, if you take a look at its max chart, for example, you will see that it has been growing through the years at a very steady pace. You don't really see insane declines here, apart from maybe 2008, I suppose, over here, 2007, 2008. where there was a little bit of a steeper decline, but overall it has been climbing. The problem that I'm having here is that if they have issues with a dividend and they have to cut down on their dividend here, then we may see a steeper decline that I would expect from this kind of company. Now, if you want to buy this one and just hold it through the years and don't really care about this, it may be an opportunity, but it's still expensive. And so while I would want to potentially get it at a lower price, this doesn't really feel like it's the price to get it for. I would probably need to be near $100 or so, or 110, maybe something of that sort, in order for me to make sense to buy Pepsico. I would have to get a steeper decline here to get a good value out of this investment. And so for this reason, I would probably have to avoid this one, at least for the time being. And I kind of don't think it's going to be close to 110 or 120 anytime soon, really. This doesn't move much. Remember, you can take a look at the company analysis, company profile page here. You will see that the beta of this company is much lower than 1. It moves much less than the overall market. It doesn't really move overall, but it could move if there is a dividend cut, and I want to avoid this one. So thank you for watching the video. I hope you enjoyed. Please remember to leave a like and subscribe if you're not subscribed already, and I'll see you soon in the next video. Again, a lot of upcoming earnings as we examined in the beginning of the video. Take a look at this one. So we're probably in for a lot of new videos shortly. Thanks for watching, and I'll see you soon again. Bye bye.